Welcome to our second chapter on mutual funds, investments for the masses. And dear students, apart from what we've learned in chapter 1 about investing and the intellectual versus the emotional issues we're going to have to deal with, this chapter is probably the most important chapter. Why? Because of how employer-sponsored retirement plans are organized and structured. Chances are, when you go out into the real world and get a job, you're going to be offered an employer-sponsored plan, 401k, a 403b, there are other versions of it. And 99.99% of them are going to have mutual funds. Excuse me, mutual funds as the investment choices. Some of them have a few other options that we could discuss later on, such as being able to buy individual stocks and bonds. But no, mutual funds are the investment choice for these employer-sponsored plans. Plus, you might want to start up your own Roth IRA, which is a phenomenal choice. Maybe you want educational savings accounts or health savings accounts. And again, most are going to be using mutual funds. So you got some studying to do. Study this chapter very diligently and bring honor and glory to Southwestern Community College, to you, to your friends and family and colleagues. Oh, by the way, there's a cute industry saying that you don't hear too much, but I love it. Mutual funds will bore you to wealth. Which is, not bad. As we've said before, and we'll say again, in the investment world, boring is good, usually. It's boring, but it's good for our financial situations. Slide number 2. What is a mutual fund? Well, if you remember from chapter 1, our very cursory quick definition is that it is an investment company that invests its shareholders' money in a diversified portfolio of securities. The idea of a pooled fund, a mutual fund. And as we said, investment company is the legal term. Now, you're not going to hear that unless you get a job in the industry. You're going to hear the popular term mutual fund. But I really like the term investment company because it says what it does. Mutual fund, I understand, a bunch of people get together and put their money together. But the investment company invests on your behalf. You need a car, you go to a car company. You need shoes, you go to a shoe company. You need investments, you go to an investment company. If you need investments, don't go to an insurance company. You need insurance, go to an insurance company. But we'll thwack insurance companies later on. And we get 2 wonderful benefits: professional money management and diversification. Now, you're going to hear some controversy. We've already made some mention of it about whether or not these professional money managers, actually earn their very lucrative salaries. And, some do and some don't. So you don't want to tar the entire industry, in my humble opinion. And also, you're going to hear some people say, oh, you don't want to be diversified. That's for wimps. That's boring. Yeah. Do you want to eat well or do you want to sleep well? The people who don't believe in diversification and believe in concentrating their portfolios, we wish them a lot well. We wish them much success, and they may do so. But it's a dual-edged sword, right? You live by the sword, you die by the sword. If your few picks work out for you, congratulations. And if not, oh well. Now, what is cool about the mutual fund industry is that there are just dozens and dozens and hundreds and now thousands of funds to choose from. Well, actually, that's a problem, isn't it? Because there are too many, in my humble opinion. And that, as we're going to see, apart from learning all the things you need to learn about mutual funds, which is very important, and you're going to do that, excuse me, the toughest part about mutual funds is just choosing your first one. because there are just thousands of them to choose from. I mean, when you walk into a grocery store, it seems like there are thousands of breakfast cereals in that one aisle, but no. Are there thousands of different cars for you to choose from? No, but there are thousands of mutual funds. And we're going to see why. There's a few reasons why. First of all, they're very, as we used the term already, lucrative for the people who run them. And also, competition has just driven the number of choices to the point where, in my humble opinion, it's absolutely ridiculous. But that's my humble opinion. And as we've already mentioned, many people will choose mutual funds for their retirement account investments, their 401ks, their 403bs, and the like, with good reason, because they make sense. For the vast majority of us, they are investments for the masses. And here is an alternative graphic. You saw the one professionally done graphic. Thank you very much, Ferrin, in Spain, who took the class and just said, I'll help you, Frank, I'll help you. So he took this one and turned it into more professional. But I want to show you that I indeed am graphically challenged. I mean, graphically adept at making stick figures. So here we are. We're the little people. And we give and those more of them are women. Those are women, folks. I trust me. And we give our $50, $100 a month through our checking accounts, through our paychecks, more if we can afford it. And we give them to the people in the top hats. These are the investment managers, the money managers, the portfolio counselors, the portfolio managers. And luckily, more and more of them are women because, as we'll say later on also, it turns out that women make better investors than men. It's already been statistically proven with empirical data, which is a fancy way of saying you just line up a bunch of women, line up a bunch of guys, and the women do better overall. I'll leave you to decide why that is. I'm not even going to touch that one with a 39.5-foot pole. But yes, the industry needs more women, and turns out women are better investors. Cool. And they create a pool of money because there are millions of these little people, you and I, out there giving billions of dollars to the money managers. And I know it kind of looks like a potato, my apologies, but it's meant to look like a pool, and that's why we get the term mutual fund. Legal term is investment company. And so these money managers, they buy stocks and for investments, and then it's called a stock mutual fund. If they buy bonds, it's called a bond mutual fund. It's funny how that works. And if they buy the short-term cash instruments that we discussed in Chapter 1, it's called a money market mutual fund. But you won't hear people use that term, money market mutual fund. They'll just call it a money market. They won't say money market mutual fund, even though that's what technically it is. And then we begin to see the explosion of different types of mutual funds with what is called a balanced fund. Balanced funds have actually been around for decades, folks. But the idea is we're going to invest in stocks and bonds. We're going to get some of the best and the worst of both worlds and hopefully smooth out the volatility that we see with stocks, still get some growth from stocks, but add some ballast, some stability from the income of bonds. So you like this graphic? Yeah? They don't get much better, folks. So if you're graphically inclined and this stuff really excites you, think about how you'd like to help Business 123 Introduction to Investments be a better class by offering to do some graphical work. Because, this book is free, right? This stuff is free for you out there. And so, yeah, maybe someday I'll hire a professional and get it done right. I don't know. Slide number 4. The growth of the mutual fund industry. What we see is that the industry started off actually back in the mid-1920s. The first mutual fund, I think, is 1924, 1926. I'm not sure exactly the date, but the idea was actually taken from the Scottish Unit Investment Trust. The Scots were the first to create the precursor to today's modern mutual fund. And by 1940, there were about 70 of these things. And the problem was that the regulators, the IRS, the states, the feds, they didn't know what to do with these things. They really were kind of in a gray area. When you make money, the IRS says, hey, we are your partners. We're Uncle Sam. And the states, of course, in California, Uncle Cal, we want you to pony up some tax. No. The mutual fund said, no, you don't understand. We're investing on behalf of our shareholders. Go tax them. And the regulators said, oh. So in 1940, the Republic rats and demagogues got together in the sandbox and played nicely and created the Investment Company Act of 1940. And it has stood the test of time. It has created the world's largest financial intermediary industry, meaning they hold money on behalf of other people, and has worked fairly well for decades. Notice between 1940 and 1970, there were growth of from 70 to 350, and then from 1970 to 1980, 600. And then with the advent of globalization and new technologies and an awareness of, hey, stocks have actually done pretty well over decades, the world started to take notice, and we go from 600 to 2000 in 1990, and then the explosion in the 1990s when the markets went in two directions, up and way up. And you see we go from 2000 to 9000, right before the crash of 2000 to 2002. Funny that happens. Ooh, is it too late to get in? Is it too late to get out? And since then, in the first fifth of the 21st century, we've added an extra 3,000. Now, if you are so inclined, the mother lode of data for the investment company industry is the Investment Company Institute.org, because it is a nonprofit. It's a trade group that is funded by the mutual fund industries. So if you are so inclined, it comes out in May. So you'll see the data for the previous year, for 2022, in May of 2023. So this goes up to December 2021. So you can see the industry has exploded. Why? We'll discuss reasons as we go along. In 1980, 5 million Americans owned mutual funds. That was 3% of their household financial assets. As of December 2021, the last reporting from the Investment Company Institute, 108 million Americans, there's only 330 million of us, in 62.2 million households own mutual funds. And that's almost 50% of all U.S. households. Again, why is that? Mostly because of the growth of 401k employer-sponsored plans and their cousins, the 403b, the 457, the 401a. Money purchase plans are called, profit-sharing plans. And as of December 31st, 2021, there was over $34 trillion, holding approximately one-fourth of household financial assets. And as such, as we've said, mutual funds are now the world's largest financial intermediary, meaning they hold money for other individuals, followed by the banks. So that they've overtaken the banks and the life insurance companies. Life insurance companies are often called the invisible bankers. Yeah. So yes, the mutual fund industry is very important to you and to your colleagues and to your friends and family. And so as rising investment gurus, dear students, study this material diligently. Slide number 5. Here we see the growth of mutual fund assets. And it's getting a little to the point where I need to sort of cut out a few years. But you can see in 2007, right before the crash of 2008, there were $13 trillion with a T. And then we had the crash of 2008. It was a very difficult year. But you might say, well, wait a minute. Why didn't it fall a lot more? Because the stock market fell over, almost 50%. Actually, from peak to trough, it did fall 56%, as I remember. Well, a lot of that money was in money market mutual funds, like $3 or $4 trillion, and so they didn't go down at all because money market mutual funds don't go down unless they break the buck, and that's a very unusual situation. And bonds didn't go down anywhere near as much as stocks. So we see it crawling back up again through after the Great Recession, the global financial crisis. And then in 2007, 17, 18, 19, 20, and 21, we see stocks doing very, very well and bonds doing very, very well, and people throwing money at the mutual fund industry. There was a small drop in 2018, as you saw, right at the end of the year. If anybody remembers, it was Christmas Eve. The market dropped about almost 7%, which is a pretty big drop. And then in 2020, there was a huge panic during COVID, but hopefully you didn't sell because it came roaring back. And then 2021 was a great year. And then 2022, not so much. And we won't see that data until a few more months. But we do know that the market stocks lost almost 20%. Some growth stocks lost a hell of a lot more. Bonds as a whole lost about 10, 12, 13%. Some did worse. Some held up pretty well. So we're going to see that we should probably see this number fall a little bit in 2022. Not a whole lot because, again, remember, it's not all stocks. But what we see is that the industry is enormous and growing ever larger. What are the advantages of mutual funds? Well, as we said, you get instant diversification because they don't buy 5 or 10 stocks or 5 or 10 bonds. They buy 150 or 200 or 500. And so diversification, as we said, you might get some people say it's not that good. It's not something you want to do. You want to be more aggressive, and we wish them a lot of luck. But we love diversification, dear students. The process whereby investors buy into a diversified portfolio of securities for the collective benefit of the individual investors. So this variety provides some safety that is difficult for an individual investor to obtain on their own. Now, it's not impossible, but it's just difficult. I mean, when we get to stocks, you're going to see that keeping track of 10, 20 stocks, that's a darn difficult task for one individual to do. You can't just buy them and forget about them. You have to continually do the processes that we'll discuss and then learn others in when we get to stocks. And so when you put $50 into a mutual fund or $100 in a mutual fund, you're buying 30 cents of Apple and 40 cents of ExxonMobil and 30 cents of Walmart. So you're getting instant diversification. And yes, as we said, some people are going to poo-poo that, but they're wrong. No, that's their choice, and we wish them a lot of success, a lot of luck, because they'll need it. And then, as we've said, professional money management. The mutual fund managers are supposed to know what they're doing. They are the best and the brightest, folks. Some of these are very high-powered individuals, and they're certainly getting paid well enough. However, as we're going to see, some do well and some do not so well. Another thing that's wonderful about mutual funds that we sort of don't really think about until we have to actually go buy some real estate or something like that and go, oh my goodness, how much money do we need? You can start with $25 a month, $50 a month. And when people say, well, I really don't have enough money to invest, I say, what's your cell phone payment? They go, well, it's supposed to be 50, but it winds up being 80 because I download a lot of ringtones. Whatever. Yeah, you can get started, folks. If you are going to $5 every week or twice a week or twice a day, I'm sorry, $6, the Starbucks, or your whatever, you can put aside $50 a month. And of course, we learn about money management, cash flow in the principles of money management class. Create your cash flow statement and see where you can get rid of some things like that storage location that has $100 worth of junk in it and you're paying $90 a month. Anyway, so you can get started very quickly with mutual funds. And one other factor that we're going to find once we've decided upon which mutual fund or funds we're interested in, is the PETA factor. Now, I wish I had come up with this name. I wish I did. But it comes from David Chilton, who wrote The Wealthy Barber, which is a wonderful book, although the numbers are all wrong. It was written in the mid-1980s. The PETA factor, the pain in the factor, is very low. Once you've chosen your mutual fund, there's nothing more for you to do. You check them every 6 months, every year or so, but their job is to do the research, the probing, the analysis, the choosing, the looking at the competitors and the suppliers and the vendors and the customers and deciding upon which investments to make. So the PETA factor, very low. Wait till we get to real estate. It's the other way around with real estate. Slide number 8. Come on, sweetheart. I got to talk nice to my computer. Here. Okay. Oh, yeah. Drawbacks. Well, hey, are they doing this for their health? No. Mutual funds are for-profit entities. So there are various fees that we're going to learn about. One of the first fees that people are confronted with are the sales charges. They go by various names: load, sales fee, but that was a long time ago that there were only mutual funds with an upfront sales charge sold through brokers, sold through financial representatives. Now there are no load funds that don't come with a front end load or a back end load. And you might say, well, of course, I want to have a no-load fund. Well, maybe yes and maybe no. We'll discuss the advantages and disadvantages of them over the next couple of presentations. But you have to be careful. Sometimes a no-load fund can wind up costing you more over time than a load fund. Why? And that's because of the annual operating expenses. Every mutual fund, well, we have to put a little asterisk, a disclaimer in a bit, has annual operating expenses. And they run from typically 0.5% or a lot less up to 2 or 2.5%. Now, what does that mean? That means for every $100 you have in your mutual fund, if there's an annual operating expense of 1%, that means they're going to charge you $1 every year for every $100 you have in the account. Now, that sounds like a lot of money, and it can be over time, but it's a whole lot less than what the banks and the life insurance companies are charging you, believe it or not. And what we're going to see is that if you have a certain type of mutual fund, which we'll discuss later on when we get to more details, 0.5%, 1%, that's not a whole lot for what they are doing, if they're doing a good job. If they are doing a good job of choosing the mutual funds, choosing the investments inside the mutual funds, then that's very typical. Now, there are some funds that don't do any research, and they should charge you very, very little. Some of them try to sneak in high charges in your 401k plan. We'll discuss that later. And there are a few mutual funds from one company named Fidelity, and we'll discuss some of the big companies in the industry that don't charge any annual operating expenses. Hey, wait a minute. How do they? Well, it's called a loss leader. For you marketing folks, you business people, you get them in the door with a loss leader. You take a loss on this one product, and then you sell them. Fry's Electronics, which is sadly gone now, but they used to have these deals. Hey, you come in, we'll give you a free strip. Electrical strip. Yeah. And then they hope you buy a 99-inch large screen television set. And so we'll see that. Now, so remember, the mutual fund is charging us. But what about the last drawback? Many mutual funds do not match the market's performance. What? Wait a minute. Aren't the mutual fund managers supposed to know what they're doing? Well, as we said, some are very good and some are not so good. And we'll see some examples of good mutual funds, and we'll see some examples of not so good mutual funds. Slide number 9. Now, here is something that most people don't even know exists, but you as rising investment gurus are going to write this down and study it because it is important for you. Most mutual funds are what we call open-end mutual funds. And that's about 3/4 of the mutual funds out there. This is the mutual fund. This is the term people use. If people use the term mutual fund without any qualifying, such as saying closed-end or you'll see ETF, they're talking about open-end mutual funds. This is a type of investment company in which investors buy the shares from and then sell them back to the mutual fund itself. There's no limit on the number of shares. Shares are issued and redeemed by the investment company at the request of an investor. So if you send the mutual fund company money, either directly or through your paycheck, they're going to create new shares. They issue new shares. When you ask for your money back, they will redeem the shares. You will redeem the shares and they will be destroyed. So investors can buy shares from, purchase the shares, and the mutual company will issue them, and sell the shares back to the investment company. You'll redeem the shares, get your money back at any time. Okay? And notice that they are by far the largest number of mutual funds. As of December 2021, there are almost 9,000 of these things, totaling almost $27 trillion. So they're the big number, the big group. The second group is called closed-end mutual funds. Now, this is a dying breed. They were never that many to begin with, and they're becoming fewer. There are fewer and fewer of them, and the assets have been shrinking. So they're about 4% of mutual funds. These mutual funds, these closed-end mutual funds, start out with a fixed number of shares. And the shares are issued to new investors when the company is organized, when the mutual fund is organized. After all the original shares are sold, then you have to go to another investor. And of course, you don't have to go knock on doors and find somebody who owns them. You go to your broker and then they're bought and sold like stocks and bonds on the open market. You incur brokerage commissions. Now, these were never as popular as open-end investment companies, open-end mutual fund companies. And as we said, they are a dying breed. There are fewer and fewer closed-end mutual funds. And notice there's only 461 of them, 461 as of December 21st. I'm sorry, December 2021, December 31st, 2021, and holding 309 billion. So 27 trillion in the open-end world, 300 billion in the closed-end world, and they are disappearing. So, what is the net asset value? Well, according to the Investment Company Act of 1940, every day the stock market is open in New York, in United States market, then the mutual fund company must compute the net asset value. What they do is they add up the value of the securities, stocks, bonds, whatever, and then they subtract any liabilities. Now, the liabilities are, hey, we have to pay the lights, we have to pay the rent, we have to, this investor, we need to pay this investor off because they've redeemed their shares. And then you divide by the number of shares that are outstanding. So it's done every day the market's open. Open-end mutual funds are sold at net asset value, and if there's a sales load, then of course they add the sales load. Since closed-end mutual funds are bought and sold on the open market, their price usually either reflects a premium or a discount to the net asset value, usually a discount. Now, it's not by much. You'll see the NAV is $25, and you'll see that the actual price is $25.10 or something like that. There'll be a disparity. They're very rarely priced at their net asset value because there's this buying and selling going on. And it's often a discount. It's often at a discount, but not much, 25 cents, whatever. So that is something that you don't have to learn how to do. You don't do it. The mutual fund company does it every day the market is open. And so the market's open till 4 o'clock New York time, 1 o'clock our time in California. And usually the mutual funds, they have to scramble to do all this. and within a few hours, by 4 or 5 o'clock our time, they've published the results for the day. So here's the formula. Again, we don't have to worry about it. It's not something we're going to learn how to do or have to do. It's done for us. We take the value of the fund's portfolio, stocks, bonds, whatever. We subtract out any liabilities and then divide by the number of shares outstanding. So in this example, if the portfolio was worth $10,050,000, we made the numbers very easy, and we owed $50,000 for whatever reason, we would subtract that and we get $10 million on the top. And if there are 1 million shares outstanding, you would divide the 10 million by the 1 million shares and get $10 of net asset value. Now, this fund had a sales commission. When we went to buy the shares, say it was 5%, they would tack on an extra 5% or 50 cents. So the offering price, as it is called, would be $10.50. Yeah, it's easy, right? You don't have to do it. Don't worry about it. Just know that it's there. The net asset value is the current value of your mutual fund as regulated, highly regulated by the Investment Company Act of 1940. So let's take a look, excuse me, my apologies. Let's take a look at the advantages and disadvantages of open-end and closed-end mutual funds. Well, open-end mutual funds have several advantages. There's no market force. You don't have to worry about finding somebody who has the shares and wants to sell them, whatever price they want to sell them for. You go right to the mutual fund company and you're able to buy and sell. Very popular. We saw almost 9,000 of these things. But from the standpoint of the mutual fund, not from our standpoint as investors, but if we have large purchases or large redemptions, think about what the mutual fund company has to do. And this is the problem, this is an issue with some companies. They become very popular. A mutual fund does really, really well. So what do people do? Me some too. Ooh, is it too late to get in? So they start throwing money at the mutual fund. And now the managers say, oh darn, what do? We gotta go, buy some more shares of the companies that we like or find new companies. And so what often happens, depending on the mutual fund company, the family of funds, is they will close a fund. They'll say, okay, you know what? No more. We can't take any more new investors. If you're with us, you can stay with us, but we'll close the fund, which can be a problem in my humble opinion. And the same thing is true when the mutual fund does poorly or the market does poorly. People start pulling their money out. Now you're the mutual fund manager and you say, wait a minute, the market's down, but it's actually, I don't want to sell these things, but I have to sell them because these people want their money back. So I'm kind of stuck. And again, it's another problem. Some companies, to get around this problem, they will just add more mutual fund managers. When I'm talking about specifically the first problem, when there's more and more money coming in the door, they'll just add more mutual fund managers and not just have one manager. But it's always a problem when people redeem their mutual funds at the worst possible time when the market's down. Oh, investing is simple, but it ain't easy. Now, the exact opposite happens for closed-end mutual funds. Because there's no more new shares, no more shares being destroyed, no more shares being issued and redeemed, the closed-end mutual fund manager doesn't have to worry about more money coming in the door or money leaving out the door. They can run the mutual fund and not have to worry about it. Again, it's not something that we as the investors have to think about. It's the problem from the mutual fund company. But some of the disadvantages of closed-end mutual fund is, first we have to buy it like a stock and pay a commission. And if you say, well, I use Robinhood and I don't pay any commissions, you wait till we get to chapter 3. We'll discuss that, yes, you are paying. Maybe you're not paying a commission up front, but you're paying. And so that means that there are market forces. And as we saw, sometimes they're sold at a premium, sometimes they're sold at a discount. These are not really that serious issues. The serious issue, in my humble opinion, is that they're just not that popular anymore. So there's just not that many good choices, in my humble opinion, although you might find a closed-end mutual fund that suits your needs. If you do, contact me, okay? Because I'd like to know more about these personally. Not that I would invest in them, not that I recommend them, but hey, they're out there, and some people are going to find some gems in the rough. Now, slide 14 discusses the relatively new, they were introduced, I think, 1992 or something like that. So they've been around 30 years now. The exchange traded funds, ETFs. And they're approximately, as we see, a little over 20% and growing. Oh, yes. They are becoming more and more and more and more popular. And what you will hear people say is, oh, open-end mutual funds. They won't even use the word open-end. They'll say mutual funds, meaning open-end mutual funds. Oh, they're the past. They're gone. Forget about them. Wrong. Wrong. As Mark Twain said, the reports of my death have been greatly exaggerated. But still, they are a force to be reckoned with. They are a hybrid of open-end mutual funds that trade on the exchange like closed-end mutual funds. So like the open-end mutual fund, there's no limit to the number of shares. As the demand for these ETFs grows, the mutual fund company just issues more shares. And of course, as they could get rid of them, they can destroy the shares. But the investor must purchase them using a brokerage account and recurring brokerage transaction fees, commissions, or the hidden commissions that we'll discuss in the next chapter. But, mutual fund companies are not stupid, especially Vanguard and Fidelity. They said, look, hey, we're going to open up a brokerage firm with the same name. It's not the same company now. It's Fidelity Investment Services or whatever. I don't know. Or Vanguard Brokerage Services. But it has the same name and it looks exactly the same. And if you buy our ETFs through our brokerage firm, we will waive, W-A-I-V-E, we will waive the fee, which is very cool, very smart. Fidelity did this first, right? Fidelity is a great marketing organization, folks. They're not stupid. And so if you want to buy these ETFs and you open up a brokerage account at the mutual fund company, no commissions. And if you say, I'm with Robinhood and I don't pay any commissions, later we'll discuss why you are paying something somehow, but maybe not an upfront commission, but you're getting charged. Slide number 15. And what we're going to see is that the ETF, look at the growth of the ETF industry. From before the Great Recession, the global financial crisis, 359, 629, and even though 2008 was a very difficult year, the number of ETFs just kept growing and growing and growing. And now, as of December 2021, there are 2,690 of these things with over 7 trillion. Again, in 2022, when the 2022 information comes out, we should see a little bit of a dip, but probably not a whole lot. ETFs are very popular and growing more popular every year. Now, let's spend a few slides to discuss how mutual funds are regulated. Again, before 1940, these things were squishy. Regulators didn't really know what to do with them. But the folks in Washington did get their act together and created the Investment Company Act of 1940, which was and still is the foundation of the modern mutual fund industry. It has worked very well. It defined what is called a regulated investment company, a pass-through investment vehicle. So in other words, the mutual fund is investing on the behalf of the shareholders. So the taxes that are needed to be paid are passed through to the shareholders. That makes sense. The mutual fund is going to make its own money on the fees that they charge, and of course they're going to have to pay taxes on that, but they don't pay any taxes on the investments, your investments, that have done very well. To qualify, an investment company must hold almost all of its assets in investments in stocks, bonds, and other traditional securities, and have very limited ability to use those derivatives and any other risky strategies that we may not learn. Well, we'll learn about them later on at the end of the semester when we just do our best to convince you to stay far away from these darn things. So in other words, stocks are risky enough, folks. Stocks are risky enough, the Congress says. We're going to keep you limited to stocks, bonds, and other traditional securities. And they must use no more than 5% of their assets when acquiring a particular security. Now, let's kind of try to figure out what that means. In other words, if you can only use 5% of your assets, and you have 100% of assets, right? If you divide 5 into 100, that means 20, right? You have to have at least 20 stocks or at least 20 bonds. You can't just buy 2 stocks or 1 stock and say, okay, I have a mutual fund. No. In other words, they're encouraging, not only, they're regulating, they're litigating, they're saying, we want you to have at least 20. Now, as we said, it's typical for mutual funds to have 150 or 100 to 200 or more. But there are some mutual funds that have decided, oh no, we're going to take this to heart. There was a very famous mutual fund called Janus 20, which most people had no idea what that name meant, and it was the number 20 was the name of the mutual fund. It meant that we're going to concentrate. We're going to have only 20 stocks, maybe a few more, in our portfolio. And it worked well when the stocks that were in the portfolio were doing well, and it worked very badly, very poorly for the investors when things did badly. And of course, they took Janus 20 and buried the evidence. This is typical in the mutual fund industry. They merged it with another fund called Janus 40. It's called burying the evidence. And anyway, so that's something that we have to remember when we're choosing mutual funds. Watch for mutual funds that do fads, and then quickly they explode in people's faces, and then they destroy the mutual fund, so you don't remember that they did that bad thing. They'll do something new bad. And then they are required to recreate an organization with checks and balances. You've ever heard of checks and balances in government? Well, the mutual fund has checks and balances. And so here is a chart that shows you that the mutual fund is not a single entity. It's actually a group of companies that work together. You might see this inverted with the shareholders at the top. I did it with our little people here at the bottom, and we're the base. I think of it as the base. That's me. The investors, and we elect a board of directors. The board of directors are responsible for overseeing the management of the fund on behalf of the shareholders. They are not responsible for the choices of investments. No. That's the investment advisor. That's the people in the top hats up here. But their job is to be your watchdog. You're the investor, they are the watchdog. Now, there have been accusations in the past where the board of directors were getting nice perks for being on the board, and they really were just sort of asleep at the wheel, not really doing what they were supposed to do, being a rubber stamp, sometimes they were called. But now 75% of the board must be independent of the mutual fund organization, and they are charged. They have a fiduciary duty to make sure that things are being run as reasonably as can be expected, folks. Some people are not superhuman, but they do their job. Their job is to make sure that the mutual fund is being run on behalf of the shareholders. Some do a very good job. Now, let's take a look at the independent entities here. By far, the most important group is the management company. The management company does the research, makes the investment, does the research and makes the investments in accordance with the fund's objectives as outlined in the mutual fund prospectus. So these are the people in the top hats. These are the people coming from the best schools, the best and the brightest, and they're getting paid very, very well. But you know what? They don't hold on to the shares. They don't hold on to the money. There's a custodian, a separate company. It's often a bank or a trust company that holds the investment choices. You see? So these guys, they're the ones saying, okay, we're going to buy 100,000 shares of Microsoft or whatever, or sell 50,000 shares of Exxon. And these are the people who actually hang on to the to the shares, or get rid of the shares when the time comes to get rid of them. Now, these two groups at the bottom, the distributor and the transfer agent, are responsible for the distribution of the shares through brokerage firms or directly to the public. So these are the people who are, they're basically they're the marketers. Their job is to tell the world, hey, we got this great mutual fund, hey, buy our shares. And the transferred agent actually processes the purchase and the redemption orders. That's a separate company whose job it is to accept the money, process the orders, and then process the redemption orders. And in between all of them is the independent public accountant. And some of you might have heard of the big accounting firms. Their job is to audit and certify the fund's holdings and the financial reportings. And of course, a reputable mutual fund will use a reputable independent public accountant. Bernie Madoff was using some guy in his garage in Connecticut. Okay. So you see how this there's something behind the mutual fund company. It's highly regulated, highly structured to protect your interest. And the next two slides are essentially a reiteration of what we just went through in that graphic. The mutual fund is a corporation run by the board of directors on behalf of the shareholders. Their job is to oversee the fund operation. The investment advisor's job is to make the decisions, the management company. They usually have what are called portfolio managers, portfolio counselors, star managers, mutual fund managers, and then typically we'll have teams of research analysts whose job it is to go out and knock on the door of Ford and GM and Toyota and decide which one's the best to invest in. The custodian holds on to the securities, often a bank or a trust company, so there's no hanky-panky going on. And then the distributors are the marketers whose job it is to, get the word out that this is a great mutual fund company. And the transfer agents take care of the purchases and redemptions. And then the certified independent public accounting firms make sure everything is on the up and up. You say you have 100,000 shares of whatever company, Nike. Where are they? Oh, cool. They're at this bank and trust company over here. Okay, good. Everything's cool. Why the large diversification of tasks and companies? Well, mutual funds are highly regulated in order to protect shareholders' investments from fraud and collapse. How often have you heard of a scandal at a mutual fund company? Well, until 2003, you never heard of scandals at mutual. Wait a minute, Payano. Did you just say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, as a matter of fact, yes, I do. Since 1940, the mutual fund industry has been regulated and escaped any hint of impropriety. Like that word, impropriety? It's a fancy word for hanky-panky, travesuras, trucos. In 2003, some practices that were not quite illegal, but obviously unethical, were uncovered. Only a handful of funds and people were affected. It was only a few people in this vast industry. And yet, of course, all it takes is a few for the entire industry to be painted with a black brush, with a terrible brush, and very sad. Putnam, poor George Putnam, rolling over in his grave. Many people thought Putnam was going to disappear. One of the storied mutual fund companies have been around since the inception. They survived. Alliance, a great mutual fund company. In fact, we're going to take a look at one of their mutual funds in the next chapter. Many people thought Alliance was going to disappear. They merged with another company and now they're AB, believe it or not. But Alliance, two people out of the entire organization. And yet it almost disappeared. Janus and Bank of America, no comment on them. I'm not a big fan of Janus. Remember Janus 20, Janus 40, yeah. And then the saddest one is Strong Funds. This gentleman was Dick Strong, Richard Strong, was the darling of the industry. He built this mutual fund company from scratch, and I forget the exact numbers, but at the time he was worth like $600 million, something like that. He was just, he had the archetypal success entrepreneur, And yet he was doing some of these silly, silly things that were, again, not quite illegal, but obviously something they shouldn't be done, barred from the industry for life. And he was very contrite, very repentant, and said, I've destroyed my life. I've let down all the people around me. I don't know why I did it. And you gotta understand, when you're worth that much money, why would you do this? Supposedly he was able to, I forget the exact number, like $80,000. He was able to tease out of the system. When you're worth $600 million, $80,000, it's nothing. It's chump change. And he said, look, you start to believe the hype that everyone says about you. You start to believe you're invincible, and that the rules don't really affect you. They're not. I know some presidents who had the same problem. And so if you're interested, check it out. Type it into any search engine, strong funds, and what happened to them, and the sad story. You don't feel too badly for him, okay? Because he's still worth a lot of money. The vast majority of companies never engaged in any of these shenanigans. And you're probably thinking, what are you talking about, Payano? Okay, well, it's a little tricky. Instead of losing all your money on a fraud like Enron or WorldCom or one of the other major frauds, or Bernie Madoff, you lost less than a penny on a $100,000 account. How could that be? Okay, let's see if it makes any sense. I'll go through it. If it doesn't, just ignore it. It's 4 o'clock on New York time, and it's about right before 4 o'clock, and it's about ready for the market to close and your mutual fund to close. And so the market did really poorly today. Fell 2%, 3%, whatever. In a couple of hours, the markets are going to open up in Asia, in Japan, and Hong Kong, and Singapore. So what you do is you sell your Japanese fund because the prices haven't caught up yet, right? It typically, if the markets fall in New York, then we're going to see the same. It doesn't always happen that way, but often what happens is it kind of goes around the world. So you believe that the next day it's going to fall 2% or so in Hong Kong or Japan. So you sell your Japanese fund or your Asian fund. And then the next day, of course, it does fall, and you buy it back the next day. You see what's going on here? Right, exactly. It wasn't illegal, but it was certainly unethical. And so what other companies, they wouldn't even allow you to do this. They would say, some companies say, look, if you sell your funds, you have to wait 30 days to buy them back. Okay, that's like American does that. I think Vanguard does that too. Other companies like Oppenheimer, which is now Invesco and Franklin Templeton, they'll say, sure, you want to sell your shares and buy them back? We'll charge you an extra 2%. And that 2% will go back into the fund, so you're not stealing from your fellow mutual fund investors. You see? So some companies set up ways to stop that from happening, but others didn't have those. So now it's obviously verboten. You can't do it. Don't try it. Mutual funds are not meant to be trading vehicles. The interesting thing is ETFs can be thought of as trading vehicles, because unlike open-end mutual funds, which most people just use the term mutual funds, you buy and sell them. You can buy and sell them all day long. You can trade to your heart's content. And none other than John Bogle, I'm never exactly sure how to say his name, but the person who made Vanguard, he's gone from us, but he's still awesome. And we quote from him in chapter 1. Remember, he talked about are you a speculator, trader, or are you an investor? He lamented what happened with ETFs. He said ETFs were never meant to be trading vehicles, but hey, it's people's money. They can do what they want with it because they're not hurting anybody, because they're buying and selling it on the open market. Whereas open in the mutual funds, yes, if you pull these kind of shenanigans, you're stealing hundreds of pennies from your fellow investors. But if there's 1 million fellow investors, that starts to add up. Okay, so what do you think, folks? Go back over, make sure you understand this material. Remember, you're going to be the investment guru for your friends and family. You can't let them down. We are so proud of you. In our next presentation, we'll discuss fees. Yes, that which we know we're being charged, we just don't really understand it very well. Well, you're going to understand it, and you're going to be able to explain it to your friends and family and colleagues, and they're going to be so proud of you as we are so proud of you. See you at our next presentation when we discuss mutual fund fees.